China's 2025 economic growth target, 5%. Sounds great, right? But for us ordinary investors, it actually represents a world of difference. Choose the right sector, and your wealth can soar with the wind. Choose wrong, and you might not even outpace inflation. Is your portfolio ready to seize this structural opportunity? Today, I'll dive deep into the 5 wealth codes under 5% growth: stocks, funds, bonds, real estate, and overseas assets. I'll show you how to build a portfolio that weather any economic cycle. This content directly impacts your wallet next year. Make sure to watch it all the way through and give it a thumbs up. Hey there. Hello everyone. I'm Juan talking finance, interpreting the macroeconomic context. First, we need to understand what 5% actually means, according to the latest projections from the International Monetary Fund, IMF. China's economic growth is expected to reach 5% by 2025. This figure not only significantly outpaces major global economies but also represents an upward revision from the IMF's previous forecast, underscoring the remarkable resilience of China's economy. This growth is underpinned by proactive fiscal and monetary policies, in plain terms, measures designed to encourage people to spend more and boost consumption. But looking at this figure alone isn't enough. A 5% increase is no longer the kind of universal growth where everyone benefits equally. It's a structural growth. This means money will flow intelligently into specific sectors, while other areas may not fare as well. There are 2 key points we must keep a close eye on. First, inflation. The IMF forecasts that China will face limited inflationary pressure, with inflation potentially reaching just 0% by 2025. Providing room for relatively accommodative monetary policy. However, globally, particularly in the United States, inflationary pressures remain significant, introducing considerable uncertainty into the flow of global capital. Second, policy direction. You've surely been hearing one term lately: new quality productive forces. This is the roadmap for the future, encompassing technological innovation, high-end manufacturing, green energy, artificial intelligence, and more. These sectors represent the value basins where capital and resources will converge in the years ahead. In short, investments in 2025 must shift from the old, casting a wide net, approach to a new, precision drip irrigation model. Our task is to identify the high-growth sectors selected by policy and trends. So where exactly is the key hidden? Let's unlock it step by step. The biggest opportunity: the stock market, precisely targeting new quality productivity. Against the backdrop of structural growth, the stock market undoubtedly serves as the most direct barometer. Moving beyond the past practices of speculating on concepts and themes, the A-share market in 2025 will place greater emphasis on whether a company actually generates profits. Our core strategy boils down to one thing: precisely targeting sectors that align with the direction of new quality productive forces, while also benefiting from the recovery of domestic demand. Analysis of current situation and opportunities. The greatest opportunity lies in the central theme of new quality productive forces. This is no empty rhetoric. We can break it down into several core tracks. Autonomy and technological innovation. As international relations grow increasingly complex, mastery of critical technologies must remain firmly in our own hands. The semiconductor supply chain, IT application innovation, high-end equipment, and commercial space industries will all receive sustained policy and financial backing. Our focus should be on identifying leading companies in these sectors that demonstrate technological prowess and steadily expanding market share. Artificial intelligence, AI, and its applications. AI is revolutionizing everything. From large language models to AI-powered smartphones, AI computers, smart vehicles, and humanoid robots. The entire industry chain is expanding rapidly. Opportunities lie not only in the technology itself but also in AI+, the integration of AI with various industries, which will significantly enhance the efficiency of traditional sectors. Domestic consumption recovery. Stimulating consumption remains a top priority for 2025. As income expectations improve, opportunities for spending will emerge. However, this recovery shows differentiation. On one hand, essential consumption like food and beverages remains relatively stable, On the other, discretionary spending favored by younger consumers, such as beauty products, travel, and entertainment, exhibits greater flexibility and potentially more growth opportunities. High dividends and the revaluation of state-owned enterprises * in uncertain times. High dividend companies that consistently pay out dividends each year serve as the ballast in an investment portfolio, providing reassurance. Particularly, many well-managed state-owned enterprises, SOEs, under new market capitalization management requirements, are increasingly inclined to reward shareholders through dividends and share buybacks. Potential risks and countermeasures *. Of course, the stock market carries risks. Disappointing macroeconomic data or the slightest turbulence in overseas markets could trigger short-term declines in A shares. Certain hot sectors, inflated by speculative capital, also face downward pressure. Therefore, the strategy should be diversified portfolio *. Don't put all your eggs in one basket. Your portfolio should include growth stocks like technology alongside defensive stocks like high-dividend equities. Research fundamentals *. Don't blindly follow trends. Take time to research whether a company is truly capable and has real substance. Long-term holding * for truly great companies. Exercise patience and let time work its magic. Don't let short-term volatility scare you away. The second biggest opportunity, fund investment. Let professionals handle professional matters *. For most investors who lack the time to research individual stocks, buying mutual funds is the most hassle-free and efficient way to share in the economic dividends. When investing in funds in 2025, the key lies in two words: selective investment. Analysis of current situation and opportunities *. Active funds * in a differentiated market. Exceptional fund managers can leverage specialized research to uncover undervalued quality companies and achieve returns that outperform the market. We should focus on fund managers with clear investment philosophies, strong long-term track records, and significant holdings aligned with the themes of new quality productive forces and domestic demand recovery. Passive index funds, ETFs. If you're bullish on a particular sector but unsure which stocks to pick, investing in the corresponding industry ETF is the best approach. For instance, through the Star 50 ETF, Semiconductor ETF, or Artificial Intelligence ETF, you can gain exposure to a basket of the most representative companies in that industry. ETFs feature low fees and convenient trading, making them an increasingly mainstream investment strategy. Thematic funds * funds centered around themes like carbon neutrality, green energy, and healthcare represent investments in a nation's certain future trends, offering vast growth potential. Potential risks and countermeasures *. Investing in mutual funds isn't a surefire way to make money without risk. The biggest risk is the fund manager's style drift, promising to invest in A but ending up buying B instead. Or the fund grows too large, making it hard to pivot quickly and negatively impacting performance. Therefore, our strategy is: conduct thorough background checks *. Choosing a fund manager is like selecting a business partner. Examine their years of experience, historical performance, and risk management capabilities. Index plus active combination * use broad-based ETFs like the CSI 300 as a foundation. Then pair them with sector ETFs you favor and a few top-performing actively managed funds to achieve a balanced approach that combines offense and defense. Stick with dollar cost averaging * for volatile stock funds. Regular fixed-amount investments are an effective way to average costs and reduce anxiety. When the market dips, the same amount of money buys more shares. Persisting over the long term will eventually yield a smile curve. The third major opportunity, the bond market, a safe haven in bear markets and a cornerstone in bull markets *. In a well-balanced portfolio, bonds serve as the indispensable stabilizer. In an environment like that of 2025, their value becomes particularly evident. Bonds may not make you rich overnight, but they provide a secure harbor when the stormy seas rage. Analysis of current situation and opportunities *. Certainty of returns in a low-inflation environment *. As mentioned earlier, China currently experiences very low inflation. Against the backdrop of persistently declining bank deposit rates, the fixed interest offered by government bonds and high-grade corporate bonds becomes particularly attractive. An unexpected windfall in the interest rate downturn cycle *. The market widely anticipates that monetary policy still has room for easing to support the economy, with potential rate cuts on the horizon. Bond prices and interest rates move inversely. When rates fall, bond prices rise. This means investing in medium to long-term bonds now not only locks in solid interest income but also offers the potential to profit from future price appreciation. The anchor of your portfolio * global economic uncertainties persist. When stock markets plummet due to various risk events, capital often floods into the bond market seeking safety, driving up bond prices. Therefore, allocating a portion of your portfolio to bonds can effectively hedge against stock market risks, reducing the overall volatility of your assets. Potential risks and countermeasures *. Bonds carry two primary risks: interest rate risk and credit risk. Interest rate risk *. If the economic recovery exceeds expectations and the central bank begins raising interest rates, bond prices will decline. Credit risk *. This refers to the scenario where the bond issuing company defaults on its debt, resulting in a debt default. This risk is primarily present in corporate bonds with lower credit ratings. Therefore, our strategy is top priority for high-grade assets * For ordinary investors, prioritize government bonds, local government bonds, or credit bonds issued by AAA-rated large corporations, which carry extremely low risk. Long-short pairing * You can configure a portfolio with both long-term and short-term bonds, like a dumbbell, to balance returns and flexibility. Bond funds as a shortcut * If you're not skilled at picking individual bonds, opt for bond funds instead. These funds hold a diverse portfolio of bonds, significantly mitigating the risk of exposure to a single defaulting bond. Fourth major opportunity, real estate market. Say goodbye to broad-based gains, focus on core assets *. When it comes to investment, real estate is always a key topic. But by 2025, the property market will have completely left behind the era when buying blindly could guarantee profits. Future opportunities will be highly concentrated in only a few select locations. Analysis of current situation and opportunities *. Core assets in core cities * Market differentiation will intensify. Premium properties in prime locations of first-tier cities and select strong second-tier cities, where population, industries, and top-tier public resources converge, will remain the moutai of real estate, retaining their ability to preserve and increase value. The key lies in great cities plus prime locations plus quality homes. Policy support stabilizes the market * The government has clearly stated its commitment to halting the decline and stabilizing the property market. With reduced down payments and lower interest rates, the barriers to homeownership are already quite low. As market confidence gradually recovers, property prices in these core cities are expected to stabilize first. Rental market and urban renewal * Under the rental and purchase coexistence policy, professional long-term rental apartments have emerged as an opportunity. Investing in properties with stable rental yields and convenient transportation access can generate consistent cash flow. The era of ready-to-move-in properties has arrived. The risk of unfinished presale projects has led more people to favor ready-to-move-in properties where what you see is what you get. Policy guidance is also steering the market toward ready-to-move-in properties becoming the mainstream. This is good news for homebuyers and represents a healthier model for the market. Potential risks and countermeasures * The biggest risk with houses is their high total price and difficulty in selling. Moreover, many analytical institutions have pointed out that properties in non-core cities may face the risk of continued price declines. Therefore, our strategy must be very clear. Focus. And focus again. Remember this golden rule: better to have 30 square meters in a first-tier city than 100 square meters in a third or fourth-tier city. Location always comes first. Avoid high leverage * With housing prices no longer rising across the board, high leverage means high risk. Ensure your monthly mortgage payments stay comfortably within your means. Focus on rental yield * Treat your property as an income-generating asset, not just a bet on price appreciation. Abandon the short-term trading mindset * Treat real estate investment as a long-term asset allocation and prepare mentally to hold for over 5 years. Opportunity 5, overseas assets, the Noah's Ark of risk diversification ***. Don't put all your eggs in one basket. This age-old adage applies not only to different asset classes today, but also to different countries. Diversifying into overseas assets has evolved from an option to a necessity for Chinese investors. It serves as a Noah's Ark, helping your wealth weather systemic risks in any single market. Analysis of current situation and opportunities *. Risk diversification *. No matter how robust China's economy may be, it still follows its own cycles. With varying recovery paces across global economies, when A shares underperform, gains from overseas markets may offset losses, stabilizing your overall portfolio. Capturing top global companies *. The global market offers many high-quality companies that are scarce in the A-share market. Take the U.S. stock market. For example, it gathers the world's leading tech giants, which continue to dominate fields like AI and biopharmaceuticals. Through global asset allocation, you can share in the growth dividends of these outstanding enterprises. Hedging currency risk *. If your assets are entirely in Chinese yuan, exchange rate fluctuations will directly impact your wealth's global purchasing power. Allocating some assets in US dollars or other foreign currencies can serve as a hedge. Potential risks and countermeasures *. The challenges of overseas investment lie in information asymmetry and complex legal and tax matters. Geopolitical factors and exchange rate fluctuations also pose risks. So, for the average person, the simplest approach is investing via QDII funds *. This is the most convenient and cost-effective way to invest overseas. Numerous QDII funds are available in the market, covering US stocks, Hong Kong stocks, European markets, and ETFs tracking the Nasdaq 100 and SP 500. Trading them is as simple as buying domestic funds. Start with mainstream options *. Initially, consider QDII funds tracking major indices in mature markets like the US and Germany, where risks are relatively manageable. Maintain proper allocation *. Overseas assets are meant for risk diversification, not gambling. Allocating 10% to 20% of your financial assets to overseas investments is sufficient. Portfolio construction strategy ***. Alright, now that we've analyzed the 5 key components, the most crucial step is coming up: how to combine them. Here, I'll provide 3 foolproof portfolio models tailored to different risk preferences for your reference. Remember, this is just a framework. You'll need to adjust it based on your age, income, and risk tolerance. Conservative portfolio, suitable for risk-averse investors and those approaching retirement. Objective ** asset security first, pursue stable cash flow, and outperform inflation. Configuration recommendations ** 50% bonds * primarily consists of government bonds, high-grade corporate bonds, or pure bond funds. 20% stock funds * opt for high dividend, low valuation blue chip stocks or dividend ETFs. 20% core city real estate REITs * hold prime real estate in core locations or invest in publicly traded REITs. 10% overseas assets gold * allocate a small portion to overseas bond funds or gold ETFs. Balanced portfolio, suitable for most working professionals. Objective * to pursue returns that exceed the market while maintaining controllable risk. Configuration recommendations * 40% stocks equity funds * balanced allocation across technology growth sectors like the Star 50 ETF and domestic consumption sectors. 30% bonds * primarily composed of high-grade corporate bonds, supplemented by a small portion of convertible bonds to enhance returns. 15% core city real estate REITs * as a long-term asset. 15% overseas assets * allocate to QDII funds tracking the Nasdaq 100 or SP 500. Aggressive portfolio, suitable for young individuals with high risk tolerance. Objective * pursue rapid asset appreciation while accepting higher volatility. Configuration recommendations * 60% stocks equity funds * focus on deploying capital in the new quality productive forces sector, such as thematic funds or individual stocks in areas like artificial intelligence and semiconductors. 15% bonds * allocate a small portion to medium to short-term bonds, keeping some ammunition in reserve. 5% real estate REITs * small allocation. 20% overseas assets * beyond mainstream indices. Consider exploring QDII funds focused on emerging markets or specific technology themes. Summary and call to action. To summarize, the 5% economic growth projected for 2025 presents us with a stage brimming with structural opportunities. Today, we have unlocked 5 major wealth codes. When it comes to stocks, focus on 2 key themes: new quality productive forces, and domestic demand recovery. Funds, make the most of ETFs and top-tier actively managed funds. Bonds are the essential stabilizers in any portfolio. Real estate, abandon illusions and focus on the core of the core. Overseas assets are an essential tool for risk diversification. When facing the future, the greatest danger isn't market uncertainty, it's clinging to outdated maps to search for treasures on new continents. May today's insights help you update your investment roadmap, so you can confidently seize your share of opportunity in 2025. Finally, we solemnly declare, all content is provided for informational purposes only and does not constitute any investment advice. Investing involves risks, decisions should be made with caution. If you found today's content helpful, don't forget to like and follow us so you won't miss our future in-depth analyses. I'd like to ask everyone, among these 5 asset classes, which one do you favor the most? What does your own 2025 investment plan look like? Share your thoughts in the comments section. Let's exchange ideas and grow together. Thanks for watching, and see you next time.